Welcome everyone to our Resource YYC Lunch and Learn. So that everyone is aware, Resource YYC is a co-working community geared to professionals. We offer our lunch and learn sessions as a means for our community to network and provide meaningful learning opportunities. We also provide private office spaces, dedicated desks, day drop-ins, and virtual office options. If you're not yet a member with us, we encourage you to check out our website and follow us on social media. Links will be posted in the chat. Today we have Herman, who provides wealth, tax, and estate planning consultations to individuals, business owners, and professionals. Over to you, Jos.
Oh, thanks so much for the introduction. I thought it's fitting because like my firm is Resources and Solutions, and then it's Resources YYC. It was like meant to be, right? Oh, thanks for joining us today. I think whenever, a new year kind of rolls around or tax season kind of rolls around, I always kind of put a little presentation around, or people ask me to do presentations, just say, where do we sit in the world? And, should I be looking at my business, my family, how they're connected, and some of the topics like that. So I've got a bunch of designations behind my name. I specialize in the tax and estate planning world. So imagine accountants like myself and lawyers that specialize in this area, much like doctors, where you've got GPs or like from that perspective. And then if you need brain surgery, you would maybe go to the neurosurgeon. And that's where, as accountants and lawyers, we can do the same thing, and we can specialize in different areas like the tax and estate planning world. So I really am excited that you're joining us today. So what we'll do is, if you do have questions in the chat, Rosemary's going to sort of monitor them, but we'll maybe try and make it as interactive as we can. And in doing so, I might pause and maybe just ask you some questions. If there's silence, that's okay too. And Rosemary tells me that you can unmute yourself, and let's see how that goes. So let's have a chat today. If I think about this whole idea of, tax and estate planning, I always start off with, everyone in Canada is going to have an estate. So maybe this is the time where, when I think about the questions we could ask ourselves, do you want your estate to be $1? Or do you want it to be maybe $1 million or more? Rosemary, what's your answer to that? What do you think? Or what would you like it to be?
I would love it to be $1 million.
Oh, how about anybody else? Is there anybody wavering more toward $1, or are we liking more toward the $1 million or more? Well, I'm thinking, Rosemary, that we've got people more leaning toward the $1 million, and it might be the case where you say, I'm going to try and spend all my money, during my lifetime, etc. And that's sometimes really hard to do. But I guarantee that everyone will have an estate. Everyone will have to deal with that upon their death. So I always say to people, you've got choice. You've got choice in how you distribute your estate. And if you think of that, I put these, sort of different categories for people to think about. The whole idea of, well, if I want to give more to CRA, so Canada Revenue Agency, they may not be as efficient as we may think, because maybe they won't distribute as much to our community and maybe your family, your heirs, etc. And I say community is because maybe that means your church, maybe that means, the charities you're involved in, et cetera, or even your own neighborhoods around Calgary. And again, I always say you have the choice to, possibly give more to your heirs and your community, and maybe not so much to CRE, to maybe provide some efficiency. So keep that in mind when we think about our estates and choice.
Robert actually said in the chat he doesn't think $1 million is enough.
Well, it's a great comment, Richard, because boy, think about this, about $1 million. If you said that to someone maybe 20, 30 years ago, you'd have people going, wow, that's a big number. That's what we shoot for. But I guarantee you, Richard, you're right. It's probably not enough. So that's why, like in my world, I always just work with people to say, how much do you need? What's some of the considerations that you have in terms of lifestyle, in terms of maybe you have people in your lives you have to take care of, and what does your business look like? So you're right, Richard. I think the $1 million is undershooting it. So I always have people that ask me, as clients, business owners, et cetera, and say, well, then how do I transfer my wealth to my family, right? Because that's eventually where it should go. And so that's one question people ask. But I think the other side of the question is, well, how do I transfer my wealth to my family tax efficiently? That's more of the question, right? I mean, you can absolutely say I give everything to people and different organizations, but if it's not done tax efficiently, then we couldn't have gotten more in terms of those choices, in terms of our heirs and maybe the community. So here's our first sort of step. I want you to break out your world in terms of your assets, your portfolios, those things like that, into different categories, one, two, three. And if you haven't done this sort of exercise before, and it's the first time, I want you to sort of compartmentalize, put them in pillars. So my first pillar that I want people to think about is you've got this registered assets in your life, maybe. These are the things that are government sort of regimed. These are the stuff where the government says you can only put in so much, Rosemary, into your RSP each year. You can only put so much into your TFSA each year. And again, when we think about RSPs or RIFs, that's what the difference between once you hit age 71, the government says, well, you know what, you can't tax shelter, you can't defer those taxes anymore in your RSP. We're going to have you take the income out. And that's where the RIFs come into play. IPPs are ones where business owners can use, and they're called individual pension plans. And these are supersize type RSPs. So any of you that are incorporated, you can have some of these IPPs as a form of registered retirement savings plans. TFSAs are sort of newer on the block in terms of where we can save as Canadians. These are in after-tax kind of dollars that go in there, and they do come out tax-free, when you do need them. And of course, pensions. As business owners, we don't have government pensions, right? We don't have that consistent source of income that comes in, but maybe your spouse does, etc. So that's our first one. These sort of registered assets, I call them much more tax deferred type of assets. The government may give you some tax credits or debt deductions now, but if you pass away, there's some tax consequences when that happens. Number two, these are our non-registered type of assets. So these are the things that, again, if you want to trade in Bitcoin and all the good stuff out there right now, or you've got some stocks floating around, we also have things like real estate. So these are things like rental properties, etc. Different tax consequences when we live, and then also when we die. So again, we only have one principal residence exemption in Canada, but if you have other rental properties, etc., you may then suffer the consequences of that tax when you pass away if you're trying to give it to your children, etc. The other one, and lastly, is sort of the third one. This is where, again, if you are incorporated, you may have share value. So you may be sitting there as Jos Herman, and you've got your corporation. There's value in there, right? So again, is that a client list? Is that inventory? Is that equipment? Whatever it may be, that adds to your share value. So as I mentioned before, each of these pillars have different tax consequences when we pass away. And we all need to sort of think about that as in terms of, are some of these able to get more tax efficiently to the next generation or not? So here's the next step we want to take. If we sort of get an idea of what our estate could look like, I want you to start thinking about, are you asking the right questions? And what I mean by that is, do you have the right documents in place, and are they up to date? So that's one thing to have, have some type of agreement, etc. And then it hasn't been looked at since 1974, whatever that, age is. So let's have a look at this. Let's have a look at some of the right questions we should be asking ourselves when we think about things like wills, So that's a really important thing to think about whenever we're a business owner. Beneficiary designations, same thing. We'll talk about this whole idea of, hey, if you're in business with someone else, maybe you need a shareholder agreement or a partnership agreement. And lastly, the most important thing I think I want you to take away from this is this whole idea of let's start to have you gather your net worth statements and what I mean by that. So again, the assets and the liabilities that you hold. So here's our exercise. We're going to go through 1 through 4. Now, if I bring up number 1 in terms of the will, you may say to me, yeah, I have one, but I haven't looked at it since 1992. Or I don't have one. You know what? I'm too busy, don't want to think about it, whatever it is. How many Canadians do you think as a percentage? And maybe I'll throw it out to Rosemary first and then see if there's anybody else that wants to pipe in. How many Canadians do you think have a will in Canada as a percentage? More than half, less than half? What do you think?
Less than half.
Interesting. Okay. Anybody else?
Valentina says less than half as well.
Yeah. I would have agreed with you. I would have agreed with you before the pandemic, believe it or not. So here's why. People had more time on their hands a little bit, right? People took up ukulele lessons and they took up bread making, but they actually did spend some time on their estate planning. And I think that's very exciting when I think of my world. So they actually started to put their wills together because there was more time to sit in front of myself or a lawyer, etc., to do these things. So we actually bumped up our percentage above 50%. So thank you. Rosemary, do you have a will?
I do not.
Okay. And why would you say that you don't have one? Is there anything you want to share? Too busy?
Busy and just, I guess because I'm younger, I've never thought about it in that sense. Like, it's always just figured, oh, that stuff can just go back to my family or something like that.
Yeah. Anybody else? Any comments on that front?
Well, Valentina says that she does have one.
Yeah. Thank you. Thank you for doing that. It's the way I picture a will is just a document that can control the distribution of your property, right? That's all it is. And again, lawyers are the ones that draft them. And they are along with any other sort of powers of attorney and things like that. So if we think about this and you say, okay, Rosemary, if you don't have a will, now I have to go to specific legislation in Alberta to say what happens to your assets should you pass away. So we have something called the Wills and Succession Act. And it was updated back in 2012, which is a good, like most of the provinces have done sort of an update in the last decade. And here's the challenge though. You may say, oh, you know what? I had coffee with my friend, via Zoom in Ontario. They have different rules over there. Each of the provinces have different rules that say what happens to your assets when you pass away and you don't have a will. So I want you to sort of just think about if you have a will and maybe it needs to be updated. If you don't have a will, this is what could happen. If your friends don't have one, or family members or other business owners you're dealing with, this is something I want you to sort of consider. So if you pass away with a spouse or what's called an adult independent partner, and this is new terminology, and that really means is have you lived with someone more than 3 years? Have you a child with them? Those types of things. That kind of puts you into this relationship of an AIP. If you pass away with a spouse and no children, your assets will go to that individual. So I think most people think, oh, well, that's okay. My husband George, he's going to get everything. No worries. Now, if we jump to, well, if you pass away leaving children and a spouse or an AIP, well, here's the thing. If all the deceased children, so i.e. me, and those children also have children of the same, so basically of the same children of the same spouse and you as the spouse would receive the entire estate. So again, that sort of also is good. So again, if those children are the same children of that spouse or AIP, then it's still going to go to that spouse or AIP. So that's not the same as any other province. BC has it a little bit different, etc. But here's the challenge. If that deceased children are not the children of the same, spouse or AIP, then we have a distribution that we have to think about or worry about, I'll say. So only 50% of the estate or the prescribed amount of 150,000 goes to the spouse. And it's the greater of. And then the remaining actually go to the children, etc. So think about that. If you've got a house that's, and those things like that, that again, you think about, well, it's just going to go to my, spouse, etc. These are things or other assets you may want to think about, is that really what you want? That only 50% goes to them or, 150,000 and then the rest go to your kids. And think about that. If your kids are 5 years old, that's that's something to really consider whenever we have minors. So again, those rules, whenever we pass away without a will, is that really the control you want in terms of, half of it not going to the right people, etc. Lastly, if you say, well, Rosemary, I'm not in a relationship, I don't have any kids or any spouses, well, then your assets will go to your parents, so the surviving parents. Okay, so that might be okay too. But if your parents aren't living, then it'll go to your siblings. And it could, if your siblings aren't alive, it could go to your nieces and nephews. So remember that sister that you haven't talked to for maybe a decade and she lives in Ontario, she may be receiving, some of your assets. And then lineally it goes by, your grandparents, again, so aunts and uncles, and then great grandparents, etc. If the government can't find anybody on sort of a bloodline basis, then the government will then have the assets. And that really, there's sort of a 10-year window under that regime. So I always go back to a will just provides you with some control. It gives you a sense of, what, if I really want to make a gift to, the Cancer Foundation or society, that doesn't allow that to happen if you don't have a will. Or again, if you have shares in your corporation, well, there's a distribution here that maybe you won't like if you don't have a will. So that's my first messaging. Do you have a will? Is it up to date? Etc. The second part we wanted to talk about again was beneficiary designations. Well, maybe I'll stop there. Rosemary, are you now going to think about getting a will? Not today, but maybe in the near future.
Possibly. Like, for me, yes, I'm one of those childless people and I don't mind it going to my parents, but definitely it's something to think about of how it's could be distributed.
Yeah, so remember, your parents would have to go apply to the courts and all those good things like that.
Yeah.
A will,
So it would make it a lot easier on them.
yeah, you're right. Yeah. That's all I'm saying. So it's just something to think about. I know we're busy and all those good things like that, but it does sort of say, here's the document. Now you don't have to have parents going to court and all those things like that. So let's jump to beneficiary designations. If we think about this, I can designate beneficiary designations and have money or funds or whatever it is go to specific people directly. So I can name an individual or even, my corporation for different types of assets. So I can name an individual like my spouse or children, etc., as a beneficiary on my TFSA. And I can do the same thing in my RSP, etc. And I can do the same thing with life insurance. So if you think about these different types of assets that we have, naming a beneficiary does give choice. Like I don't have to go back into the will and make changes, etc. It bypasses probate. Probate is a tax. Each of the provinces apply it. It's not a big thing in Alberta. We only get charged $525 on our estates. But if you also think about, life insurance, et cetera, as an asset, those assets are always received tax-free. As opposed to, let's say, your RSP, it can go to your spouse. But if you're trying to give your RSP to your children because your spouse has already passed away, or maybe you're in a second marriage or whatever it is, the estate will pay the tax. Then you have the amount going directly to your children. So be cautious of that. Which assets are tax-free and which ones are not tax-free to the estate, etc. So a lot of people then say, you know what? I use life insurance as a way to provide tax-free dollars to individuals in my life, or I can give it to a charity, etc. So I gave you a little list here of sort of the attributes that comes with life insurance that I think maybe people don't always appreciate whenever they think of the different assets that they have. So it can enhance your estate. So again, if we go back to Rosemary's situation saying, oh, you know what, $1 million would be good because I want to give to the SPCA or something like that, then that can be more of an enhancement for her estate. There's no tax when the insurance grows during her lifetime. If she decides to move away from Calgary, she can take that policy with her wherever she goes. So that's kind of a neat little feature if we think about everyone kind of moving around globally. And again, no one needs to know that she has this insurance contract. It's sort of a nice confidential thing at the end of the day. So I think whenever we think about the assets that we have, and it goes back to are some of them tax-free? Are some of them portable? What's the tax consequences when we die? This really comes down to the reason why a lot of people have things like life insurance as one of their assets. So thinking about this, and we go, okay, my wills are up to date, my powers of attorney are up to date as well. I can name beneficiary designations on different assets that I have. That's another good thing. I want to kind of jump to number 3 and 4. And this is where it comes down to really you as a business owner saying, okay, if should I be considering these things in addition to 1 and 2? Well, number 3 talks about shareholder agreements. And shareholder agreements come into play if you have a corporation and you are in business or with another shareholder. So it might be your brother, it might be a friend. So depending on the circumstances. So given that scenario, if we go to the idea of, we've got your shares that you own in your corporation, and let's say you passed away. What happens to your shares? Do they go to your spouse? Do they go to the other shareholder? All these kind of considerations need to be factored in. So I always say to people, if you are in some type of situation where you've got a corporation with other people, or you know people that are in situations that they have a corporation with other people, then they need to have a shareholder agreement. And a shareholder agreement basically says, what are the 6 things that can impact you as a business owner? And this document would outline all the things that would happen. So let's say that one of the shareholders died. So again, I go back to what happens to those shares? Do they go to a spouse that maybe you don't like, or they don't have the financial aptitude to be in that same business as you? What happens if you become disabled? So again, do I continue coming to work? Do I have the capacity to? And what happens when you want to retire? There needs to be some language in this document that sort of outlines, does someone buy me out, etc. And what happens again with, in the situation where you've got another shareholder and they've gone through a marital breakdown, right? So again, there's different complications there. And what happens if you just don't like each other anymore? And it is truly a reality. And I come across it all the time. If they're brothers or they're related, or people that aren't related. So shareholder agreements are drafted by lawyers. These are the ones that, again, they put specific clauses that address each of these certain events. So this applies again to if you have a corporation and you're a shareholder, or if you're in a partnership with somebody, or in a joint venture if you're with another party. These shareholder agreements act as a business will. It outlines what happens in these certain events. So think about that. Does this apply to you? Does this apply to other people that you know are business owners? These are real events that can happen, and you need a document, much like a will, that outlines what happens to my shares, all these things, given these certain events. Okay. This is the one where, again, number 4. So we've gone through sort of the steps and sort of saying, what's my, checkup should be here. Well, I always encourage everyone to, again, put together their net worth statement. This whole idea of what's your balance sheet? What assets do you own personally? And what assets do you own from a business standpoint? And this might be your corporation, or this might be you as a self-employed individual. This really just lays out the whole idea of what assets are personal. So I want everyone to break it out on the top in terms of personal. What assets do you have? So again, you might have a house. So put a value to that, right? We can sort of get an estimate from, a realtor, etc. If you have other real estate, again, whatever that rental property is, etc. What's the value of that? And maybe you've got some RSPs, etc. Those assets are different than your corporate assets or your business assets. Those assets are dealt with differently when we pass away. And then you would add your liabilities. So is there a mortgage on the house, mortgage on the other properties, etc. So given that, now you can start to look at what are the corporate side of things. What are the assets that you have corporately? So again, do you have a holding company? Or do you have a business where you've got an operating company, and that's where you sell your services, etc. So think of this then as your balance sheet. The idea that at the end of the day, what happens to these particular assets when you pass away? So let's assume that it's $3 million. Given this, the exercise that I do with clients and business owners is I sort of say, okay, what's the fair market value? So FMV, and those are the same numbers that we saw above. And is there a tax consequence when you pass away? So again, we mentioned before, we have a principal resident exemption in Canada, and everyone is able to get that. So that might be changing. Who knows? We've heard rumblings through our last budget, but they didn't want to touch that. The other real estate, the RSPs, your corporate owned shares, these have tax consequences when you pass away. In addition to the tax, there's also what I call exposure. And exposure really just means, and I put the kind of list here on the side here for everyone to give you a sense of, well, what happens if you lose capacity, right? So let's say, you're going along, and also maybe Alzheimer's starts to, and dementia maybe play a part, or, illness plays a part. So a lot of these things are, do you still have the capacity to control these assets when you no longer can? And that's, again, the function of, do you have powers of attorney, etc. I also want you to think about, do you have assets not just here in Alberta, but do you have other assets, maybe in another province or even another country? I don't know. But these have ramifications of someone having to deal with these assets when you pass away. So again, when you start to put your net worth statement together, now you sort of get a sense of what your executor could be dealing with. As a business owner, you may have some assets, again, that are personal assets, and you may be able to provide some creditor protection if we name some beneficiary designations. So a lot of people use segregated funds as a way to sort of provide that creditor protection as well. So again, what creditor protection do you need going forward? And a lot of this comes down to control. I mean, if you said, well, I only want my estate to be $1, then people would say, well, I'm going to give my assets away now. But now you're losing control, right? You're losing control of that asset, and that's, probably not what you want. And then finally, what this exercise does for people is to say, okay, well, who's going to receive these assets? Like if you have people in your lives that have a disability and whatnot, we can create trust for them to provide some protection. We could say that, well, it doesn't make sense for them to receive the assets, to them personally, or people that, are minors in your life. So again, those that are under 18. So think about your net worth statement. The whole idea of, does it make sense that certain people were receiving certain assets? What I want to jump to though is my A and B there on the side. And I've got some acronyms there, TIC and JTWRS and tax. I want to jump to that. So I'm gonna ask Rosemary, have you put together a net worth statement in your world?
No, I have not. But generally, it's just looking at my bank account.
Yeah,
So,
yeah. Oh, I
so if
hear you.
that counts, then sure.
Yes,
But
it does. It absolutely does. Absolutely. Oh, and now I'll open it up to anybody else. Has anyone sort of gone through this exercise of sort of putting their net worth statement together and sort of said, oh, you know what? There's going to be tax here, and if I give this asset to a minor, does that make sense in my planning? So I'll pause and see if anybody in the chat has any comments there. Yeah, I kind of, it's not an exercise we do every day. There's, Netflix is there and all those other stuff that we sort of, lean toward in terms of doing and taking care of our businesses. So it's not an exercise, but I want you really to think about doing it because again, there's so much ramifications involved with the particular assets and liabilities we have. So let's jump to this whole idea of joint ownership and tenants in common. And why I bring this up is because some of your assets may be held with different people, right? So maybe it's the house that you own with someone else. And I want you to think about the ramifications of how you own it. So we've got two ways of owning property. One is joint tenancy and one's tenants in common. And so if you own something with joint tenancy, that means that if the person dies, the remaining owner actually acquires the share automatically. So that makes sense. I mean, if we think about maybe your house, you have maybe your spouse as the other joint tenant on it. So that if you passed away, the house automatically goes to the spouse. I'll call it simple estate planning. It makes sense for most people. But that may not be the case where, again, if you've got, a child, and some people like to put their children on as, the other owner. So I want to bring up tenants in common. So tenants in common means I've got my ownership and maybe the other person has 50%. When I die, though, it doesn't automatically go to the other person. It goes to my estate. And so if my estate says I give to my 5 kids, now that's a different issue as opposed to joint tenancy. So I want you, again, think about how you own your assets. Are they, joint tenant or are they tenants in common? And if you think, well, I'm going to, add my children on as, a joint owner, you're going to come across different considerations, I'll say, or issues that, and I'll give you an example. You name Johnny, your son, as the joint owner in the house. And you think, okay, well, that's a great idea. I can just give the house to him, etc. Well, the question is, was there a taxable disposition in doing that? So that's the first thing. And then what happens if you have 4 other children and Johnny receives this asset, this house, and it's worth $1 million. And the other kids are going, wait a second, mom said that, the estate goes to all of us, and that's what the will says, etc. Or maybe she doesn't have a will. Well, now that's, was the intent, and I put that in red, that you really gifted this asset to Johnny? Or was the intent that it was for the estate? So I really want you, again, don't be, jumping to the gun of adding children to ownership of property, etc. There is ramifications of such. And again, it's really prevalent, I think, in a lot of provinces that are trying to avoid probate. So if you go to BC, their probate is 1.4% of the estate. So a lot of people go, well, my estate planning is I'm going to just name my child as the other joint owner so we can bypass the estate and not pay probate. So my word of caution when we go to that. So Rosemary, do we have a comment on that one? Because I'm sure.
We have a question actually. How
Yeah.
much is the tax on real estate?
Yeah, so let's kind of jump to that. If we go to this idea of our real estate example here of 600,000, and let's say you bought the property for 100,000 or 300,000, we have a capital gains tax in Canada, whereby 600,000 minus the 300,000 will be our capital gain, and half of that now is taxable. So that's something where people don't always realize from that perspective. And that's why I bring up this whole idea of tax liability. Does that sort of answer the question? Because if we went to the United States, they've got an estate tax, and that's the issue there. They've got, if I have assets in my estate, and they will apply estate tax. We don't have that in Canada. We have a capital gains tax when we pass away. But there is some exemptions in the US. And is there another question or comment?
We just have a thank you because
Oh,
I think that
perfect.
answered the question.
So let's jump to that. Thank you for leading into that. This whole idea of tax liability. So I want to bring up the whole idea of if you have shares in a corporation, and it applies to, again, real estate and other things like that. The Income Tax Act says you're deemed to dispose of your shares and all the other assets you have for their fair market value. So I can't pick, the value of your company to be $1 or the value of the real estate to be $1. What happens is, and I'll give you just a really quick example here. Let's assume that the value of your shares were 1.3 million. Okay. We do a calculation to say, okay, well, now we've got the fair market value. What's the cost of the shares? And that really just means the ACB. And the same applies to that real estate example. Then I have a capital gain. And when I die, I have to do a terminal tax return, so a T1, and it applies a capital gains rate of 24%, and that's currently up for 2021. So there's a tax bill just on my shares of a little over $311,000. And that's just by you owning shares of your corporation. Or if you, again, and the same applies to real estate. That tax is owing when you pass away on that final T1 terminal tax return. And I put there on the bottom, along with your other tax exposed assets. So this exercise, I think, is always very shocking for business owners because they're like, well, what do you mean? I pay tax when I live. When I want to retire, oh, I've got some more tax there. And then when I pass away, you're telling me that I've got some more tax. And it's kind of, whenever I do this calculation for clients, they're shocked because we don't get taught this in school, do we? We get taught, what's the hypotenuse of a triangle and all these things like that, geometry, but we don't get, taught what happens when you pass away, what's the tax ramifications, etc. So something to think about. This whole idea of the tax liability, like I said, I do this for people all the time. And I basically put their assets together from their net worth statement. I do an estimate of what's their fair market value and what's their cost. And then I try and do a calculation of what's their capital gains tax if they passed away today. And then what's the capital gains tax if they passed away. And right now, life expectancy is about somewhere about 85 in Canada. So what's your tax bill now? And then what's your tax bill, again, maybe 20 or 30 years from now? It's something I think that we really have to sort of plan for. And it might be the 311,000, but as we kind of grow in wealth, it could be much more. And that's the scary part for a lot of people. And the question then comes down to, how do we pay for this tax liability when we pass away? So keep in mind, in our Income Tax Act, if you're married, then sort of your tax burden kind of grows with you and your spouse. Let's be honest. I can roll those assets to your spouse without triggering any tax. I don't have to trigger tax in doing that. So here's the question then, is if now we're pushing the tax, and let's say I pass away and I've sort of given the assets to my husband, I've really just pushed the tax over to him when he passes away. And so that's where lot of people don't, get concerned about tax, because they go, well, it's just going to go to my spouse. It's their issue. So the concern comes down to many of these tax deferred assets become taxable when we try and give it to the next generation. Or, again, people in our lives that, may need some extra help, etc. So again, this whole idea of tax liability, it's an area of tax people don't think about. So ultimately, I love this question. How do people feel about tax? And I'll say it's the ultimate tax question. So I will get people that say, you know what, if I pass away, it's not my problem. It's my kid's problem. Or, you know what, I'm going to be a good Canadian and I will pay my fair share of taxes. Or, if the government gets one more dime, I'm not going to give them one more dime of my money from a tax perspective. So, Rosemary, where do you sit in the world of tax? How do you feel about taxes? Do you like paying them?
I understand what they're for.
So you're a good
But
Canadian? Yeah.
I try and find the best balance.
Yes. Oh, anybody feel balanced about how they feel about tax, or are some people saying something different? I would love to hear.
Valentina says that she thinks it is fair to pay taxes.
Okay. Yeah. 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 Because I mean, ultimately, we think that it should go to the programs, the people, all those things like that. Yeah. I mean, it is fundamentally a good Canadian thing to do. Any other comments on that front? Yeah, I think it goes down to what we pay in tax. And we've seen our tax rates, they've risen. I mean, they over the years, and this is the personal tax rates. So if we pay ourselves more than basically 300,000 out of our corporation or salary, wherever we are, we're sitting close to 50%. And if we're paying ourselves dividends, it's a little bit, I'll say, cheaper at about 42. And there's our capital gains tax rate in Canada. So it's basically half of the 48%. We're sitting good, I'll say, from an Alberta standpoint. As we move more east, they see much higher taxes in terms of greater than 50%. But I'll say that we've certainly seen the rise of income taxes from a personal level over the years. The last budget, no one wanted to dare touch have increases in the taxes, and but we'll see as we kind of move forward of what that looks like. Corporately, for 2021, we've seen some interesting now opportunities, I think, from a corporate standpoint. If I make less than $500,000 in my corporation, I get taxed at 11%. Anything above $500,000 gets taxed at 23%. And you're seeing a number there, passive investment income, and we'll get to that one. That's close to, again, 46, 47% in Canada, or sorry, in Alberta. So this is why people incorporate. You may not be incorporated now, but if you think about, paying 11% inside your corporation, if you do need some money or salary out of the corporation, then you can sort of distribute accordingly. So there's not one always right answer to do you incorporate or not. It's a discussion to certainly have with your accountant. But again, the Alberta tax rates have gone down from the corporate side. The one I mentioned there, the 46.7%, where did you come up with that, Yoss? So if you have a GIC that's generating interest income inside your corporation, that gets taxed at a really high rate. That gets taxed at almost 50% or the 46.7%. So that's where a lot of business owners are sort of concerned, because we now have a system where I'm trying to create some maybe retirement income in the future, but the way our corporate tax system works is you pay a higher rate of tax, not the 11%. You pay a higher 50% tax almost if you're trying to maybe have a GIC or something in your corporation to generate some income, so that when you later on retire. So again, something that a lot of business owners are sort of facing now. So think about this. If you are incorporated or thinking about being incorporated, and even going forward as someone who's self-employed, you're taxed on the income you earned, right? If you are incorporated, you're going to be taxed on the income trying to distribute out of the corporation. And I mean that also in terms of when you pass away. So as your wealth grows and that corporation value grows, there's going to be tax on those shares, as we saw before in our example. And so again, think about the tax that we sort of get burdened as business owners. What people are realizing, just from a tax planning perspective, a really simple one, is that insurance is playing an important part in their business planning. And I kind of want to just sort of highlight why people are sort of leaning toward using this kind of strategy. It offers tax-free growth. And again, when you think about particular assets, that's a kind of a neat and a feature. It provides liquidity. So again, if you pass away, tax-free dollars can be received to pay for tax liabilities, to pay off debt, whatever it may be. And if you have a corporation, it allows for tax-free dollars to come out of the corporation. So, I don't get to use the word tax-free too often in the tax and estate planning world, but this is where a lot of practitioners are sort of saying, well, business owners should be looking at corporate insurance or some type of insurance to give them these kind of attributes. So I think of why people, if you're incorporated, why this makes sense from a tax planning perspective is because we can trigger what's called a capital dividend account, so CDA, and we can allow for tax-free dollars to be paid out of the corporation when someone passes away. So be it a spouse, be it you, etc., that allows for tax-free dollars to come out. And again, have those opportunities to maybe keep the business going, or etc. So again, that's what people do from a tax planning perspective. So I wanted to just highlight here just some of the examples of where business owners are doing some of their tax planning, using things like insurance, etc. Because they're going to have RSPs and TFSAs, but when we think about this asset that people have, and if you're the main business owner, and if you're the main person in your family that provides that income, what happens if you're no longer here, etc. So my first example is business owner one. This is where two brothers have a corporation, and I've sort of mentioned this before, where, think about that. If one brother is involved in the business and the other brother sort of does some other aspects of the business, one of the brother passes away. And now, under the will, let's say, or maybe there's no will, the shares go to the other brother's spouse. And so that's a question of, do you want that to happen? Um, and it goes back to, do you have a shareholder agreement, et cetera. So again, this is where people use insurance to say, you know what, we'll have money for the family, the brother's family, should the other person pass away. So again, really simple planning that some tax efficiency can happen. Some other business owner examples are they use insurance to pay off debt. So if you go back to the example of, oh, my corporation or my business generates so much income, et cetera, and maybe you started off your business with some debt. So you went to Scotiabank, said, give me a loan. Well, you can have, your family pay off the debt with the insurance proceeds, and then they can sort of maybe continue on with the business or whatever it may be. So it allows for, the opportunity to have, the bank satisfied with the debt that is around. So again, simple planning. Um, the other one, under three, and boy, I see this a bit where people are saying, well, you know what, I'll just sell off the assets, or my executor will sell off the assets, like my real estate and all these other things, when I pass away to pay my tax bill. It can be done, right? But again, think about the timing that your executor has to deal with. They have to now, try and find a buyer, get the real estate agent on board. Is there a will that allows for all this to happen? So that's one of the, I'll say, issues when you think about that. And if we go back to our conversation about, do you own that property in joint tenancy or tenants in common? Are you able to sell the property? Does the other person want that to happen? So again, selling assets to pay for tax liabilities is not, I'll say, the most efficient thing that we could be doing. And then finally, just in general, I mean, start thinking about your tax liability, having that calculation done. There's, it can be 100,000, it could be hundreds of thousands, or, people that I work with, it's jumping up into the millions. So be cognizant of what it is now and what it could be for you, your family, your business, etc. That's the concern that I have for a lot of folks that haven't done that exercise yet. So here's where I'll kind of close off our conversation. This checkup is really to say, you know what, this planning is not only for you as a business owner, but, again, your children might be involved in the business or not, but they may receive some assets from this. You may have other family members that haven't done any of this estate planning. Like, I mean, sisters, brothers that don't even have a will, etc. Or other fellow business owners that you're dealing with. I mean, they may be, much like the two brothers scenario, or they're in business with other people, etc. So this checkup really comes down to, you might be busy, but it just takes some extra time to sort of think about some of the things that you could be doing in your, checkup as we kind of ended our tax season. So think about your will. Think about, does it need to be updated? Does it need to be done? The other estate planning documents, like powers of attorney, if you lose capacity, can someone still go to the bank for you? Beneficiary designations, again, are they up to date? Or do you still have an ex-spouse still named as a beneficiary? You need to update those. If you're in business with anybody else, make sure you have agreements that sort of dictate what happens under certain events. And again, the exercise that I hope everyone just starts to do, what does that net worth statement look like? What's the tax ramifications? If we want to pass these on to certain people, and, maybe want to grow our net worth. I don't know. That's, that is absolutely a lot of the things that we need to consider, because as we go into retirement and we stop working, now what other type of assets can we rely on for retirement income, etc. So think about your checkup. Think about your 1, 2, 3, 4. And if I think about some of the, reasons why we should be doing a checkup, is because, again, things change in our lives. The assets change. The whole idea of what's my tax liability when I pass away. this is sort of the things that I do for folks. So I just put my contact information there. If people do have questions, we covered a lot of stuff. And again, the whole idea of, if can we do something, those little steps to make sure that we maybe provide some tax efficiency, maybe the assets go to the right people, etc. And again, I think there's ways to make some simple planning happen for individuals. I have a 604 number there because I still have an office still in Vancouver, and I have my office here in downtown Calgary. So I want to thank you for your time. I want to thank Rosemary for for indulging me on my questions. I loved it. Thank you. And I think it's just one of those opportunities that I think that will help us going forward into 2021.
Well, thank you very much for getting a few thank yous in the chat as well. And it was very informative. And yeah, I think it's definitely something for everyone to think about now.
Yeah, absolutely. So I want to wish everyone a great day. Enjoy the rest of your week. And again, just have a little checkup. And and if you do need some extra help, like I said, there's my information. So have a great day, everyone.
All right. Bye, everyone.